Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are undertaking a critical investigation into the newly formed Paramount Skydance Corporation, trading under the ticker PSKY.
And this is a big one. We're looking at their very first financial reporting period since the monumental combination of Paramount Global and SKYDANCE. They call it the NAI transaction and, well, the transactions.
It's a huge corporate engineering project, and we're going straight to the source material for this, the Form 10Q filing.
That's right. And we're analyzing a very specific, and I have to say, a very unique window of time. It's what the company calls the successor period.
Which runs from August 7th through September 30th, 2025.
So just a 55-day snapshot.
Yeah.
But it is our first official financial look at this combined entity, under the Ellison family's control.
Our mission today is to really synthesize this complex stack of documents. We need to nail down the new company's initial financial baseline, see how the individual business segments are performing, and I think most crucially, we have to understand the profound impact of this ownership change and the subsequent accounting shift, which makes reading these initial reports feel a bit like translating an ancient text.
You are not kidding.
Right.
And if there's one term that really defines that challenge, it's this accounting maneuver they've used.
Yeah.
The push down of ultimate parents basis. For anyone out there trying to compare the results of the old Paramount Global, what they're calling the predecessor, to the new Paramount Skydance Corporation, the successor, well, that comparison is just fundamentally broken.
It's completely unreliable. You're looking at two financially distinct entities that just happen to occupy the same corporate shell.
Exactly.
The moment those transactions closed on August 7, 2025, that was it. The music stopped for the predecessor. The successor period began instantly.
And it reflects a complete reset.
A complete reset of nearly all asset and liability values to their estimated fair market value. So we have to treat the predecessor results. That's January 1st to August 6th. And the successor results as completely separate universes of data. They're only connected by, management's strategic intentions.
So let's start there. Let's define the new structure and financial baseline. Before we even touch a single dollar figure, we need to understand the mechanics of this deal and, I guess, who's actually running the show now.
Okay, so the transactions officially closed on August 7th. The result was that the key operating companies, Paramount Global and Skydance Media, they became wholly owned subsidiaries of the new holding company, Paramount Skydance Corporation, or PSKY.
Yeah, this wasn't really a traditional merger, was it?
No, not at all. It was more of a highly engineered corporate takeover. It was designed to streamline control and, more importantly, to infuse a massive amount of capital into the business.
And the outcome of all that engineering is
Right.
definitive control.
Definitive control. It now rests with the Ellison family, specifically Lawrence and David Ellison. Their indirect stake, which is held through their acquisition vehicle, Harbor Lights Entertainment, gives them the controlling interest.
How much control are we talking about?
They now hold approximately 77.5% of the voting class common stock.
77.5%. That's absolute, unequivocal control.
And that consolidation of power is reflected in the leadership structure, too. David Ellison isn't just a major stakeholder. He took on the crucial dual role of chairman and CEO of the combined entity.
Which tells you they're not passive investors.
Not at all. They are fully committed to operational control, to steering the ship through what's going to be a massive transformation.
And that control was only possible because of the capital injection that happened alongside the merger, the PIPE transaction.
The private investment in public equity, yes. This provided the cash component and established the immediate liquidity for the new company. The total investment was a colossal $6.0 billion.
And that $6 billion wasn't just, dumped into a general fund. It was strategically allocated, which tells us a lot about the priorities of this deal.
A great deal.
So let's break that number down, because the allocation is critical. A really large chunk of it, $4.45 billion, was explicitly set aside to fund the cash stock election.
Right, which was offered to the former Paramount Global holders.
So that was the exit rep.
Exactly, that was the mechanism. It was designed to satisfy any shareholders who wanted to cash out, rather than roll their investment into this new, unproven, restructured entity. It was the financial lubricant needed to get the deal done smoothly.
And the remaining cash, the $1.52 billion.
That was provided directly to PSKY for immediate corporate purposes, for strategic investment. This cash infusion is the working capital. It's the fuel that David Ellison's new management team is using to execute the restructuring, to pay for the staggering severance costs we're going to talk about later, and to invest in the future of the streaming business.
It fundamentally changed the company's liquidity profile overnight. So in exchange for this PE investment, the NAI equity investors received 400 million newly issued Class B shares, and those were priced at $15 per share.
Which establishes a baseline value for those controlling shares, but there's a key kicker.
The warrants?
The warrants. The NAI equity investors were also granted warrants to purchase an additional 200 million Class B shares.
And the exercise price on those?
The strike price is $30.50 per share, and they expire in 5 years.
$30.50. That is a huge indicator of management's ambition for the future, isn't it?
It absolutely is. I mean,
Right.
for them to make serious money on those warrants, the stock has to more than double from that $15 issue price. It has to push past $30.50 within 5 years.
That puts a very specific valuation target on the new management team's head.
No question. And looking at the total share count now, as of early November 2025, the total Class B common stock outstanding was 1,071,666,977 shares. That is the new capital base they have to manage.
Okay, let's turn to the hard numbers then. For that short successor period, just those 55 days from August 7th to September 30th, these are the GAAP results, the official initial baseline. Revenues came in at $4,121 million.
And on the expense side, total costs and expenses were $3,877 million.
Okay.
So that yielded an operating income of $244 million for that brief period, which honestly is a decent start given the chaos of closing a merger of this size.
Right, but when you drill down to the bottom line, the actual net loss from continuing operations, it was a loss of $13 million.
A loss of $13 million, yes, which results in a diluted EPS from continuing operations of -1 cent. So a technical loss right out of the gate based on official GAAP accounting.
And this is exactly where we have to introduce the concept of accounting noise.
Right. Management insists, and I think rightly so, that this GAAP loss doesn't reflect the underlying operational strength. They argue it's polluted by merger costs and non-cash accounting adjustments.
So they provide their own numbers, the adjusted non-GAAP metrics.
And those metrics, they swing the results dramatically positive. The adjusted OIBDA, that's adjusted operating income before depreciation and amortization, was a surprisingly robust $655 million.
Wow. And the adjusted net earnings?
That flipped from that $13 million loss to a substantial profit of $138 million.
So the adjusted diluted EPS comes out to $0.12.
12 cents. Now here's the analytical rub. The difference between the GAAP net loss of $13 million and the adjusted net earnings of $138 million. That's a massive $151 million swing.
And you have to ask why. That's a critical question. For you, the listener, that $151 million gap is where the real story of this merger lies. So can you help us unpack that difference, not just listing the items, but explaining why management is or isn't justified in taking them out?
Of course. We can attribute this difference to two main categories of exclusions, and they're distinct. First, you have the immediate one-time merger costs.
Restructuring charges.
Exactly. The successor period alone booked $185 million in these charges, mostly severance and realignment costs. Management argues, and most analysts would agree, that these are costs associated with changing the business, not running the core business. So you back them out to see the true operational health.
So that's the cost of the corporate diet the new entity was immediately forced to go on.
A perfect way to put it. The second factor, and this is the enduring impact of that pushdown accounting, is the non-cash amortization.
Okay.
The JAP calculation includes significant amortization expenses from intangible assets that were kind of artificially established when Paramount Global's net assets were recorded at fair value during the merger.
So it's an expense that shows up on the income statement, but no actual cash is going out the door.
Precisely. It's an ongoing non-cash drag. And since it doesn't involve cash flow or day-to-day operations, it's typically excluded for that adjusted OIBDA metric. It makes the GAAP result look much worse than the cash flow reality.
Let's delve deeper into this push-down accounting then. This really is the technical heart of the report. The predecessor, Paramount Global, was essentially revalued at an estimated fair value of $11.588 billion as of August 7th.
Right. And it's important to understand the mechanics here. Since the Ellison family controlled both Paramount and SKYDANCE, this was treated as a combination of entities under common control. For the Paramount Global part of it, the rules required recording its net assets at estimated fair value.
Which means writing up or writing down assets and liabilities to reflect their actual worth at that moment in time.
It's like taking an inventory of an estate you just inherited and marking everything to its current market price before you start managing it.
It's a great analogy.
Meanwhile, SKYDANCE was combined at the ultimate parent's existing basis, so the result is this highly complex, layered balance sheet. But the most important outcome is how it affected the company's debt profile.
Okay, let's focus on that, the impact on debt. The total face value of the debt, the actual amount PSKY ultimately has to repay its lenders, that stayed high at $14.98 billion.
Correct. But the carrying value, the value listed on the balance sheet for accounting purposes, dramatically decreased. It went down by $898 million because of the push-down adjustment.
How does that break down?
It's a composite of a few things. They reversed about $390 million of net unamortized discount and $71 million of unamortized deferred financing fees.
And then there's the big one.
Yes. The big one was a $1.36 billion reduction to adjust the debt to its estimated fair value.
So this is the strategic insight. What does that mean in simple terms?
Debt is a liability, of course, but its fair value changes with market interest rates. At the time of this merger, given the interest rate environment and market perception, their existing debt was essentially worth less than its face value on the open market.
So they got to reset the debt's carrying value lower by over $1 billion. It sounds like financial magic, as if the debt just shrank, even though they still have to pay back the full $14.98 billion. What's the strategic benefit here?
This is management effectively buying themselves lower reported interest expense for the near future. Because the debt is now recorded at a lower carrying value than its face value, that difference, the $898 million, will be amortized back up to the face value over the remaining life of the loans. This amortization creates an artificially low non-cash interest expense benefit on the income statement for years to come.
So it masks the true cost of their capital.
It does.
A bit.
And it helps flatter their reported interest coverage metrics. It's a huge strategic advantage, especially right after a highly leveraged transaction.
Okay. Now, conversely, how did the pushdown impact the asset side of the balance sheet?
The effects there were more mixed. The total programming assets, so the value of their enormous film and TV library, actually saw a net decrease in book value overall.
Which is also a positive for future earnings.
It is. It means lower content costs will hit the income statement in future periods, less content amortization expense, which is a key operating cost for a media company.
But I remember seeing an interesting carve-out within that.
You're right. Specifically within the film entertainment segment, they actually saw an increase in the recorded value of some of their library content due to the pushdown.
So it's complex.
It means we can't apply a single rule. Every asset category was reviewed and adjusted, sometimes up, sometimes down. But the net effect on the income statement is generally favorable by lowering future non-cash expenses.
That sets the stage beautifully. So we're dealing with a company that has been fundamentally re-engineered and, let's say, financially scrubbed. Let's shift our focus to segmental revenue and profit trends. What did those 55 days tell us about the core business drivers?
Okay, we'll start with the overall revenue disaggregation for that August 7th to September 30th successor period. The largest category, and by far the most stable one, was affiliate and subscription revenue.
How much was that?
It pulled in $2,027 million. This is fees from cable distributors and, increasingly, those recurring direct subscription fees from streaming.
And after that?
Advertising followed at $1,280 million. Then you had licensing and other, which is selling their content to third parties, at $775 million. And the smallest, most volatile category, theatrical revenue, was just $39 million.
So that composition shows a clear reliance on those recurring affiliate and subscription streams.
It does. But to get a meaningful picture of the market trends, we can't just use that 55-day period. We have to rely on management's pro forma combined numbers,
which fuse the predecessor and successor periods for Q3 2025.
Exactly. It allows for a reliable year-over-year comparison against Q3 2024. This is essential for understanding the structural dynamics of both the old and the new businesses.
So let's start with the biggest and most complex business unit, the TV media segment. This is a legacy broadcast and cable empire. We're talking CBS, MTV, Comedy Central, Nickelodeon.
For that short successor period alone, they generated revenues of $2,368 million.
And an adjusted OIBDA of $540 million.
But the pro forma year-over-year comparison paints a really stark picture of market contraction. Total TV media revenue decreased a punishing 12%.
12%.
It fell from about $4.3 billion in Q3 2024 to $3.8 billion billion pro forma in Q3 2025. That double-digit decline is steep.
And that 12% drop is fueled by the twin engines of decline in the legacy space.
Right.
Advertising and linear subscriber loss.
That's it. Advertising revenue decreased 12% overall. It dropped from $1.67 billion to $1.47 billion pro forma.
And the breakdown of that advertising decline is fascinating.
It is. Domestic advertising decreased 8%, which is bad enough. It reflects secular cord cutting and just reduced ad spend. But the international advertising revenue, it saw a significant, almost catastrophic decline of 27%.
27%. That is a massive hit. Why such an acute decline internationally?
The report suggests a combination of factors: sustained global economic weakness affecting ad budgets overseas, intense competition from new digital entrants, and notably, they were comparing against prior periods that had the benefit of political advertising, which is cyclical. Plus, there were some recognized revenues in the prior year related to past underreporting by an international sales partner that complicated the comparison. It just shows a highly unstable international market for linear TV.
And the second pillar of TV media, affiliate, and subscription revenue also declined.
Yes, though less dramatically. It dropped 7% from roughly $1.87 billion to $1.74 billion pro forma. And this is just the simple, painful story of linear subscriber declines. Cord cutting marches on year after year, and it's eroding the most reliable revenue stream this business ever had.
And the last piece.
Licensing. Licensing and other revenue in TV media fell 22% pro forma. This is driven by lower revenues from content they produce for third parties and just fluctuating secondary market licensing. It's likely due to competitors pulling their own content back onto their own streaming platforms.
So the key takeaway for the TV media segment is just structural contraction across the board.
Across the board. And this structural stress is the context for the merger and the massive restructuring plan. It's important to remember the predecessor company was already recognizing this decline before the merger even closed.
Right, through those accounting adjustments. We saw significant impairment charges reflecting market stress.
Specifically, $157 million in FCC license impairment charges in Q2 of 2025 and another $104 million back in Q3 of 2024. These assets were officially deemed less valuable even before the Ellisons took control.
That historical context really validates the aggressive cost-cutting initiatives we're going to discuss. Management knew they were acquiring assets that were structurally stressed and, potentially overvalued on the books.
Without a doubt.
Okay, now let's pivot entirely. Let's go to the direct consumer segment, the DTC segment. This is the future bet: Paramount Plus Tay, Pluto TV, and BOT Plus. For the 55-day successor period, this segment generated revenues of $1,284 million.
And here is the headline that completely flips the narrative about PSKY's strategy. The DTC segment posted an adjusted OIBDA of $235 million for the short successor period.
What, positive? An OIBDA of positive $235 million.
This is not a loss. This is a significant positive profit contribution from streaming. For years, the market narrative has been that streaming is a cash bleed, necessary for future relevance. This report suggests that for PSKY, that era might be over.
That is a huge deal. It flies against years of market expectations. How sustainable is that figure? Or could it be an anomaly, maybe artificially boosted by the pushdown accounting?
Well, the pushdown certainly helped on the asset and amortization side, but the operational growth is very real. If you look at the pro forma Q3 results for subscription revenues, they were the absolute star. They increased 26% year over year.
26%.
Rising from $1.34 billion to $1.69 billion. This growth is driven by a combination of successful subscriber acquisition and, crucially, pricing increases for Paramount Plus Rye. It suggests they are finally achieving the scale necessary for profitability.
And the subscriber metrics support that scale argument.
Absolutely. Paramount Plus global subscribers reached 79.1 million as of September 30th. That's up 7.2 million, or a solid 10% year over year.
And even during Q3 itself, they added 1.4 million net subscribers. That pushes them right up to that 80 million mark.
That growth rate is commendable in a highly competitive market. However, we do have to note a key financial hygiene item that's starting in Q4.
Okay, what's that?
Management has committed to excluding certain subscribers from the reported numbers going forward.
You're referring to the 1.2 million customers who are registered in a free trial as of the end of September.
Exactly. They will be excluded from the official reported subscriber numbers starting in Q4. And this is actually a positive step for transparency.
Yeah.
Cleans up the metric. It ensures that the 79.1 million figure truly represents the paying or recently paid subscriber base, rather than including tire kickers who might never convert.
It shows management is prioritizing profitability and reliable data over, inflated headline numbers.
I think so.
What about the advertising side of DTC? That wasn't as rosy.
No, pro forma Q3 advertising revenue declined 6%. Even the streaming ad market is not immune to challenges. The report notes the impact of new digital entrants into the marketplace, like Amazon and potentially others, all vying for the same ad dollars.
So even with Pluto TV as a leader in free ad-supported streaming, the competition is getting more intense.
It's clearly intensifying. It demands constant innovation.
Okay, let's move to the third segment, filmed entertainment. This is the combined power of Paramount Pictures and the newly integrated SKYDANCE divisions, animation, film, TV, games, and sports. For the successor period, revenues were $480 million.
And filmed entertainment operated at a slight adjusted OIBDA loss of $13 million in that short period.
Which isn't totally surprising for that segment.
No, this segment is inherently high risk, high reward.
Right.
Its performance is entirely dependent on the timing and success of major releases. That loss should really be viewed as the cost of maintaining a major content engine.
Theatrical performance thankfully showed some growth. Pro forma Q3 theatrical revenue was up 4% year-over-year.
Up from $108 million to $112 million. The key releases in Q3 were the comedy reboot, The Naked Gun, and the animated feature Smurfs.
But to understand the true strength of their content slate, you need a longer view.
You do. And pro forma theatrical revenue increased 29% for the 9 months ended September 30th. This was heavily driven by successful earlier releases, notably the strong performance of Mission: Impossible, The Final Reckoning, and Sonic the Hedgehog 3.
So the content is working, which gives the DTC platform essential ammunition.
And the SKYDANCE edition is already proving its worth in the licensing category. 9-month licensing and other revenue increased 7% pro forma.
And that's directly tied to SKYDANCE.
Yes, this increase specifically reflects the immediate licensing of SKYDANCE's The Family Plan 2 during the successor period. So SKYDANCE's strength in film and TV production is now flowing directly onto PSKY's income statement.
What about on the cost side for filmed entertainment? The report mentioned content costs were increasing.
They are, and this is a crucial point of the merger analysis. The cost increase reflects two unavoidable factors. First, the inclusion of SKYDANCE's specific content production costs, which were added upon integration.
Makes sense.
And second, the lingering effect of the pushdown accounting, which resulted in an increase in the recorded value of library content that now has to be amortized. While that amortization is non-cash, it still impacts the operating line items. It reflects the higher basis the Ellisons paid for the assets.
The story that's emerging is one of significant contrast, isn't it? The decline of the legacy business is essentially funding the soaring success and immediate profitability of the DTC segment.
That contrast sets the stage perfectly for the massive corporate overhaul detailed in the next section. It brings us to cost structure, execution, and outlook. The Ellisons and the PSKY management team inherited a gigantic, often redundant organizational structure, and their immediate response has been aggressive and decisive.
And the most immediate, painful, and quantifiable step is those restructuring charges. During the successor period alone, PSKY recorded $185 million in these charges.
Which we mentioned earlier is mostly severance costs. It's the expense of reducing headcount to align the combined business around strategic priorities, including a voluntary employee separation plan.
And this wasn't a one-off event confined to that successor period. The predecessor company was already cutting deeply.
Very deeply. From January 1st to August 6th, they had already incurred $255 million in restructuring charges, plus another $199 million in transaction-related fees for banking, legal, and advisory costs.
So if you add that up, we're looking at $445 million in severance and exit costs for just the first 9 months of 2025, plus another almost $200 million just to get the merger done. That is a truly shocking amount of money just to right-size the organization.
And management's outlook shows that this is not finished. They provided guidance stating they expect to incur an additional $500 million in restructuring charges for severance during Q4.
Wait, another $500 million? On top of what they already spent?
On top of everything. And that's just for Q4 2025. That brings the total restructuring commitment to nearly $1 billion in just over a year.
Okay, if they're guiding for another $500 million in restructuring in Q4, that suggests these charges are not merely one-time merger cleanup. They feel like a core, ongoing cost of this transformation. Should we really be backing them out when we look at adjusted OIBDA if they're recurring quarter after quarter?
That is a highly critical question for analysts to ponder. Management classifies them as non-recurring adjustments necessary for future savings. But the sheer scale and the projected continuity, you could argue that massive restructuring is now part of the operational reality of PSKY.
It sounds like the merger was just the legal foundation. The real work, the painful, expensive organizational transformation is just beginning.
They are trading immediate massive expense for future synergy savings. That's the bet.
And beyond just cutting headcount, these transformation initiatives are also focusing capital on modernization.
Yes, we see cash flow being dedicated to advancing technology, to unifying all the disparate systems from the Paramount and SKYDANCE organizations, and migrating all operations to the cloud.
Which are crucial but often overlooked investments.
Very expensive investments. Unifying systems and moving to the cloud reduces long-term operational costs and improves efficiency, but it requires massive upfront capital expenditure and execution risk. This is future-proofing the company.
Let's circle back to the accounting changes, specifically that profound shift in depreciation and amortization, which is directly linked to the pushdown accounting.
Right. The successor period D&A was $226 million. That's far higher than the $96 million in the comparable Q3 2024 predecessor period.
Why did it jump so drastically?
The primary driver is a massive accounting estimate change. It's regarding the company's FCC broadcast licenses. These licenses, which are vital for the TV media segment, had a significant unamortized balance of $2.49 billion.
And historically, they were classified as indefinite-lived intangible assets.
Indefinite-lived, meaning you don't amortize them. They just sit on the balance sheet at cost unless you impair them. They were treated as permanent assets.
But not anymore.
Not anymore. Management reassessed this classification due to what the report calls sustained declines in industry projections.
That is a stark accounting admission of permanent loss of value. They're essentially admitting through their accounting that the broadcast business has a shelf life.
Precisely. They reclassified the licenses as finite-lived assets and began amortizing them on a straight-line basis over 30 years, starting in Q3 2025.
So that $2.49 billion asset is now being depleted on the balance sheet.
It is. And this new amortization is a permanent, non-cash expense that will significantly depress future GAAP net income, which justifies why we must continue to rely on adjusted OIBDA to evaluate the operational core health. This move is symbolic of the structural shift away from linear TV.
Let's discuss liquidity and debt management. With that huge cash infusion from the PITE, how healthy is the new entity's balance sheet?
From a liquidity perspective, very healthy. Cash and equivalents stood at a robust $3,263 million as of September 30th. This reflects that $1.52 billion cash injection for general corporate purposes we noted earlier.
And they also retain significant financial flexibility.
They do. They maintain a $3.5 billion available revolving credit facility, which matures in January 2027. And crucially, they had no outstanding borrowings on that facility at the end of the period.
So they can tap $3.5 billion if they need to. That's a powerful safety net.
A very powerful safety net for executing their transformation plan. And management successfully navigated their key financial covenant, the consolidated total leverage ratio. The maximum allowed for Q3 was 5.00x, and they met that easily.
But that covenant gets tighter soon.
It does. It's set to step down to 4.5x by March 31st, 2026. Hitting that target signals a commitment to deleveraging and maintaining credit market confidence, which is vital given the size of their total debt load.
There's a structural detail in the debt profile worth noting. The weighted average interest rate on their senior and junior debt was 5.17%.
Yes, and let's look closely at the junior subordinated debentures. They include $627 million due in 2057 and another $989 million due in 2062. These are very long-dated liabilities.
What's the significance of that specific structure? Why so long-dated?
It's highly strategic. Because of their extended maturity and their subordinate position to other debt, the rating agencies grant them a crucial 50% equity credit.
Meaning they're treated partially as equity for calculation purposes.
Exactly, for calculating key debt ratios used by the rating agencies. It's smart financial structuring that allows PSKY to carry slightly more leverage while still appearing less leveraged in the eyes of the credit markets.
And finally, in terms of shareholder returns, even amid all this financial engineering, they still declared a dividend.
A 5-cent common stock dividend in the successor period, totaling $58 million. Maintaining even a small dividend sends a signal of corporate stability and confidence, reassuring investors that the core business remains capable of generating returns.
This brings us to the messier side of things: contingencies and regulatory risks. Despite all the forward momentum of the new entity, the legacy issues and the controversies surrounding the merger itself continue to weigh heavily on management's time and resources.
The most immediate threat is the ongoing merger-related litigation. These are multiple high-stakes lawsuits alleging breaches of fiduciary duty related to the NAI transaction and the subsequent merger terms.
And the existence of this litigation isn't just a financial drain.
No, it forces the CEO and the legal team to dedicate significant time just defending the very foundation of the company itself.
So let's start with the Gabelli action, which was filed just after the merger closed.
This is a putative class action seeking damages, and potentially damages that could unwind the transaction related to the merger terms. Gabelli is trying to represent former minority holders of the pre-transaction Class A shares who felt the deal was insufficient.
Then there's the high-profile and frankly dangerous NYSERS action, filed earlier in 2025 by Major Retirement Systems.
And the core allegation here is explosive. It's that the no-shop provision in the transaction agreement prevented the special committee from adequately considering a significantly higher alternative offer.
An offer made by Project Rise partners. And that alternative offer was substantial, wasn't it?
It was. $23 per share for Class A stock and $19 for Class B, notably higher than the final deal structure.
So if the court sides with NYSERS and agrees that the no-shop provision was invalid, what happens?
It could threaten the financial foundation of the merger. The plaintiffs are asserting that SKYDANCE and the old controlling shareholder, Sherry Redstone, breached their fiduciary duties. And it's complicated by the fact that SKYDANCE agreed to indemnify Redstone for certain breach of fiduciary duty claims.
Where does that stand now?
It's currently in discovery, which means lawyers are sifting through internal documents. The stakes could not be higher.
And there's a third front in this legal war, the 220 action.
This is where stockholders are aggressively seeking access to the company's books and records to investigate potential breaches of fiduciary duty related to the transactions.
The fact that this case has reached the Delaware Supreme Court on an interlocutory appeal just about the scope of document production, it signals the intensity of shareholder mistrust.
It does. Shareholders are demanding full transparency to determine if they were shortchanged.
On a more positive note, the litigation docket did get one lighter. That rather bizarre lawsuit filed by LiveVideo.ai Corp. was dismissed.
And not just dismissed. The judge imposed $10,000 in monetary sanctions against the filer and barred them from filing future lawsuits regarding the transactions in federal court.
That's a clean win. It eliminates one distraction and sends a clear message against frivolous challenges.
Definitely. Now, beyond the merger turmoil, PSKY also manages significant operating and historical liabilities. The most notable, and one that stretches back decades, is the persistent issue of asbestos claims.
Stemming from Westinghouse, a predecessor company from before the 1970s.
This historical liability is a constant multi-decade burden. As of September 30th, PSKY is defending approximately 17,540 pending asbestos claims,
Which is down slightly from the end of 2024, but still a huge number.
It's a serious historical contingent liability that has to be estimated and maintained on the balance sheet. It's a massive historical cost that they must constantly manage.
Another historical risk that was fortunately resolved was a dispute regarding distribution agreements.
Yes, the company reached a settlement with Sony Pictures Television, Inc. concerning the exclusive right to distribute Wheel of Fortune and Jeopardy.
And that's a favorable conclusion. It removes a major potential distraction and preserves the rights to two of the most profitable, steady properties in television history.
It's a quiet but significant operational victory.
We also have to address the related party transactions, given the nature of the controlling ownership by the Ellison family. Lawrence Ellison, David Ellison's father, is the chairman of Oracle.
Right. Transparency is paramount here. PSKY disclosed that it paid $2 million to Oracle during the short successor period under existing software-as-a-service agreements.
Which are likely standard business agreements, but they require extra scrutiny.
Of course. And furthermore, PSKY has lease agreements with an entity owned and controlled by Lawrence Ellison. They incurred $4 million in lease costs during the period, with a total remaining lease liability of $191 million on the balance sheet.
So again, these are disclosed transactions that have to be continually reviewed to ensure the controlling shareholder isn't benefiting unfairly.
Even if the transactions predate the merger.
So in final synthesis, This Q3 2025 reporting period reflects a truly dual and sometimes contradictory reality for Paramount Skydance.
It does. On one hand, you have the clear, aggressive investment strategy yielding immediate results. Highly profitable subscriber growth driving the DTC segment to a strong adjusted OIBDA of $235 million. That strategic pivot is operationally succeeding. It justifies the premise of the merger.
But on the other hand, the legacy TV media segment is suffering structural market contraction, forcing management to initiate this painful and costly organizational transformation. The pain is evidenced by the $185 million in immediate restructuring charges and that commitment to another $500 million in Q4.
And the new team is fighting legal battles on three high-stakes fronts: Gabelli, NYSERS, and the 220 action. They're burning cash just to justify the deal that created the company, while simultaneously navigating these massive permanent accounting shifts like the FCC license amortization.
So the tone of management is one of confidence and aggressive execution, but they are clearly operating under immense pressure and scrutiny.
This initial report establishes the floor for this new $11.6 billion entity, but the immediate future demands sustained operational discipline amidst unprecedented market disruption and shareholder challenges.
The question for you, the investor, is what trend truly dictates the company's trajectory from here?
And that leads us to our final provocative thought for you to consider.
We have the direct-to-consumer segment delivering positive adjusted OIBDA, demonstrating that the strategic pivot to streaming is paying off operationally and providing crucial growth. Yet, the legacy TV media business demands nearly $1 billion in restructuring cuts over the next year just to align its bloated cost structure with market reality. Which trend, the acceleration of the DTC business or the structural decline and subsequent overhaul of the legacy TV media business, will ultimately dictate the financial success of the new PSKY entity over the next fiscal year? Will the growth engine overcome the corporate gravity and the legacy assets?
This is the high-stakes balancing act David Ellison and his team must perfect.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful Markets, Measurable Meaning.